But again, part of the move in this new corporate tax law is to lower the deductibility and restrict the deductibility of interest. What I really, wish they had done is they should have excluded dividends paid from the corporate tax. I mean, as long as they exclude interest, why not exclude dividends? Or they should have gone towards, you don't pay tax on dividends if it's reinvested into the stock. And that would put it exactly on par with capital gains taxes, which, as you know, are not paid until realized. I was really quite disappointed in that there was not any further reform that was done on dividends. I mean, we had Bush tax cuts, lowered the rate on dividends for the first time under the normal income tax rate. There could have been other very positive changes that would have lowered debt on the part of corporations if they had favored dividends that were not pushed for, not part of the Republican agenda, and not included in the final text.
Thank you. And we have time for one more question before we take our networking break. And go ahead.
So you had mentioned that corporations should be funding at these low interest rates with debt. It's a wise decision from a CFO treasurer. Is there a differentiation between investment grade debt and high yield where you may not be as cash flow positive? And to that point, if interest rates do go to 3.25% on 10-year and the yield curve does flatten with more Fed movement, how does that impact the high yield market? Is there a difference between that and IG, or is that very similar?
As you guys know, the high yield market is really a blend of a investment grade corporate with some stock kicker in it. So, maybe weight 3/4 on interest rates and 1/4 on what's going on in the stock market when you're trying to value high yield debt. If interest rates move up to 3 1/4 and the stock market stays robust, it won't have much of a negative effect. If interest rates move up and that causes a reaction in the stock market, you will see at that point a sharp correction in the high yield debt. I hold on. If people ask me, Jeremy, do you hold any bonds? I say the only bonds I hold long-term, reinvested high yield. That's it, because it has a lot of stock characteristics. And when you reinvest, you get the dollar cost averaging advantages are huge in that market because of its fluctuation. But I still, even looking at today's PE ratio, still strongly favor stocks as compared with high yield debt, and certainly investment grade debt with interest rates going up.
Thank you, Dr. Siegel. We will now be taking a 10-minute networking break, and then we will be resuming for the Student Investment Challenge at 10:05. Thank you.
running PowerPoints like it's a job. There you go, eat. I never ate before. We. Oh, I can stop this.